Good afternoon, everybody. Okay, before I start, I want to confirm, can you guys hear me and see me?
Yes, sir, I can hear you.
Oh, that's good, good, good.
Yeah.
All right. Okay, from this week, we are going to have all our classes will be online. Okay, sometimes I might close the videos because of the stability of the internet connection. Yes. And yes, so far I can see I have 7 participants so far. Okay, do you guys have any question to ask me? Is any question for me, guys? No? Okay. All right, today we're gonna talk about workshop 4. All right. So can you guys see the screen that I'm sharing?
Yeah.
Good.
Yes, sir.
Good, thank you very much. And I'm gonna download workshop 4. Okay. All right, I think we're ready to go. Should we start? Let's start.
Yes.
Okay, all right, let's start it. Today our topic is actually capital asset pricing model. We will actually discuss, you have already, I believe most of you have already listened to the videos provided by Dr. Girisha. And he actually summarized in there the whole CAPM model in there. And in this class today, I'll be talking about the main points, and also I'll be talking about the exercise. Okay, we'll be talking about some of the exercise. I don't know how many of you have tried it on last week, but I will actually go through a little bit on these things as well. So that's what we're gonna do today. We're gonna actually talk about CAPM model, and we're gonna solve a couple of questions from here as much as we can. All right. So let's start from the beginning. When we talk about capital asset pricing model, what it is actually. Okay, yes. Did you guys get a chance to listen to the lecture actually? Yeah?
Yes, sir.
Okay, that's nice. That's good actually. Yes, very good. And I have so far 9 students, 8 students present in here. Good. Okay. So what is a CAPM model? CAPM model is actually a model that actually tells you how much will be your required return, how much your return, how much is your return required to compensate the risk you are taking by making an investment in an asset. Now, as I told you on the beginning, that in financial corporate finance, this subject will be actually, when you talk about assets, we do not actually mention the physical assets like operating assets. For example, let's say equipment, machineries, building, not that. We're talking here about financial assets, which are your various type of financial instruments you're talking about. Okay, so let's say you have decided to make an investment in a share. Okay, in a share, you are actually making an investment. So it's very natural. It's very natural that I told you from economics point of view that humans are responsive to the incentives. From that perspective, if we talk, an investor will always look for some return. He'll look for some compensation that risk he is taking. So how much needs to be paid? How much is required for taking? How much return is required for taking that risk? Will be actually described. Will be actually calculated by using this CAPM model. We call that capital asset pricing model. Okay. So it's very simple in here. Like if you look at the history in here, the CAPM model originally developed in 1952 by Harry Marquis and fine-tuned over a decade by many others. So yeah, so he actually gave this idea, and slowly it has been developed by other scholars as well. How the model looks like? Here we go. Let's go to the model in here. The model will look like this. This is the model you will look like. Okay, the model is like this one. This is the model. So you can see that. Okay, that's the model you have in here. And this model has been described what is RJ, what is RF, what is beta J, what is RM minus RF, all these things mean. Okay, we'll talk about these things today. So the first thing they're talking about RJ. Okay, RJ is actually your return on an asset that you're going to actually make investment. Okay, how much return is required if you want to take a risk. Okay, now what are the risks coming from? Risk has two ways. Risk may come from two ways. Okay, since you're taking a risk, you're expecting some return. Now the question comes up: where the risk coming from? Risk coming from actually two ways. It comes from two different perspectives. One is systematic risk. Another one is unsystematic risk. Okay. So we discussed in last class as well about these two different type of risk. Okay. So the risk we are talking in this chapter is systematic risk. So two types of risk. Let me write it down. That will help you guys to understand better. Let me get a new page. So we have systematic risk and we have unsystematic risk. The systematic risk and we have unsystematic risk. Two different types of risk. So this systematic risk, this risk you can actually, you must have to take this risk. You cannot avoid this risk. Unsystematic risk, this risk you can avoid. Okay, it is possible to avoid. Okay, systematic risk, it is not possible to avoid. Now, it will be much more clear if I give a little bit more example about it. Now, when you talk about unsystematic risk, these risks are coming from, let's say, manager's mistake. Okay, let's say operation of business is faulty. Okay, these things are fixable. Okay, manager's mistake, operation of business is faulty, then they did not make the investment on time. So these are various types of mistakes that people make, the managers make, management make, okay, which could have been avoided. But systematic risk, when you talk about this one, this is unavoidable. Okay, this is unavoidable. All right. So since the unsystematic risk, this is actually diversifiable. Okay, we can say diversifiable risk. and this is not diversified. You cannot diversify them. Not diversifiable. You cannot diversify them. Okay. So now, two different, let's make it a bit better so you guys can see it better way. Two types of risk. The beta we are talking, like here on this CAPM model, we said that, look at here the beta, you can see here the beta. This beta is actually telling you the risk that you're taking. Which risk? We're talking about systematic risk. Okay, this is a systematic risk. Like in last class, I actually showed you how the standard deviation is actually showing you the volatility into the market. Okay, so standard deviation will tell you the variation. It will take you the how volatile the return is. That's what we showed you in last class, right? And that is actually showed that the standard deviation, which is sigma. So sigma, when you talk about sigma and beta, okay, let's go back in here again. So now, two different types of we're going to show in here. So let's put at the first one, I will say here, let's talk about sigma. Okay. If we talk about sigma, here it is. Sigma is actually expressed through sigma is equal to two types of risk is take. It take systematic risk, okay, systematic risk plus unsystematic risk. Both together will be your sigma. But when you talk about just the beta, okay, so when you talk about just the beta, so this is not sigma anymore, this is going to be your beta. And you go in here, this is beta. Beta is talking about only systematic risk. Okay, so two different types of things we have in here. All right, so let's make it red color so you guys can remember that. So sigma is actually your standard deviation. Here I can say here, okay, SD, standard deviation, which actually representing your systematic and unsystematic one. Okay, now let's going back in there. So here we are talking about unsystematic risk, which you cannot avoid. Okay, so this says here, return, RJ. RJ, what is RJ? Required or expected return on an asset. How much you're expecting making investment. Let's say you want to make an investment in a company called PQR, a company I want to make investment. Here they say company name, company J. Okay, J share you want to purchase. You want to purchase a share named J. Okay, so now share J is required. How much you are expecting to have a return. Very simple. I'll give a very simple example. I'll give you now. Okay, it's very simple. As I said, nobody will be willing to make investment until otherwise they get something in return. I mean, the incentives they must have to receive. Okay. Now, so let's say you have some money. You have some money in your pocket. What are you doing with the money? If you're smart, you're putting it into some savings account or doing something that you're keeping your money in such a place where you'll guaranteed will be given 2, 3, 4% of interest. Okay. Okay. So you are actually planning to actually have some money and you're planning to make some investment. But before making investment, you kept all your money in a savings account. All money you have is kept into the savings account. Then what you did is that savings account, for example, list is giving you, for definitely for sure, is giving you a, let's say 4% interest is giving you, or not that much, they don't give that much. Let's say 3% interest they're giving you. Okay. Savings account interest rate, for example, is equal to 4% you are getting. Okay. Or you can say 0.04, you're getting an interest rate. So why I'm bringing up savings account? Because saving account is the account that we call the risk-free. You don't have to take any risk. You are definitely getting this amount for sure. It could be from savings account. It could be from government bonds too. In Australia, UK and USA, these countries they take the government bond as the most secured and least risk. There is no risk, almost negligible risk. So those bond, treasury bond they use, or long-term bond they use as a risk-free interest rate. So how much interest they are getting from there, that's what we call the risk-free interest rate. Okay, they call it risk-free interest rate. Okay, which one is that? You can say government bond, long-term, you can say long-term government bond. You can say treasury bond. Okay, T-bills, treasury bond, yeah. So these things are your risk-free interest rate. I'm giving you, like normally we get this thing as a guaranteed from savings account in a bank account. Banking is also safe. We treat it as a safe, yeah. So that's also called your interest, risk-free interest rate. Okay. Okay, let's say savings account that you normally have. All right. Now, what you expect? Your money is already in your savings account. Your money is earning 4%, definitely for sure. Right? You're earning your money that you have in there, earning 4%. Now, if I come and tell you, do you like to buy a share from me? Let's say, for example, I told you, my share is from company J. Okay. Company J, my share is company J share, and I want you to purchase this share. And definitely you're going to ask me a question. Well, if I want to purchase your share, I'm already getting now 4%. I should get something more than that. Otherwise, why should I actually take out my money from the bank account and invest in your company share? What for? I need to have some incentives in return. So what you getting? You're getting this. I show you. So here it is. I'm going to take it now, okay, and put it in here, and I'll show you part by part how it works. So this is the thing you're getting. How much you're getting? You're getting this one, RF. This is risk-free. All right. This is the thing you're getting, RF. So if I take it, yes. So that's my equation in here. So I'm going to actually show you part by part. So this one is actually your 0.04. Okay. All right. So this is your 0.04. That's what you are getting, RF, risk-free return. Plus on top of it, you're getting this whole part. On top of it, what you're getting? You're getting this whole part. You see that? This red part. So you are getting your 0.04 plus you're getting this extra. How much is in here? We need to look into that. How much is in here? I could be looking into that one. All right. So now we need to actually break down these things. What is in here? Okay. It depends actually on beta coefficient. You see this beta in here? This coefficient, this one will be actually deciding that how much you're gonna get. If beta is equal to 0, how much you getting? You're getting nothing extra. So beta becoming 0. If beta j becoming 0, for example, okay, let's say here, You're saying beta j is equal to 0. Okay, so this one is equal to 0. Okay, so what happens? See, the whole thing will become 0. Whole thing. See, this whole part will become 0. If that is the case, then what? If this the whole thing becoming 0, then what happens? See, this whole thing becoming 0. And let's strike through this, gone. So you see, your return of the share you're investing in J will be equal to your risk-free return. Okay, so beta is 0, so you don't be taking any risk. There is no risk. There is no extra benefit you are getting out of it. So now, if you go for, like, let's say beta is equal to 1, okay? Now, you can ask me a question, how much could be the beta values? Oh, beta can change. Beta values can be, like in this one here, I showed you here, you can see beta value can go more than 1. It can. Like Dr. Girija here actually showed you in the class, and even in here too, you can see how the beta values is coming up, interpretation of beta values. It can go less than 0. It can go more than 1. Let me show you in here. Okay, here you go. So you can see here, you see on this one, this is actually hat. Okay, what is hat? This thing is called estimated beta. Okay, beta value could be less than 0. It could be equal to 0. It could be within 0 to 1. It could be equal to 1. It could be greater than 1. Okay, so beta value can have any figures. It can have any values. Okay. All right. Now the question comes up: how do we explain if the beta value is actually 1 or beta value is greater than 1? So I look at here, like beta value is greater than 1. What does it mean? Okay. So like let's say beta value is 1.5. What does it mean? It means implies that if the market return increased by 1%, return on asset J will also increase by 1.4%. So these things are actually coming from regression analysis, how to interpret the coefficients. Okay. So this is from actually this is a, let's say this is a state line equation in here. Just a state line equation in here. And we are explaining how the beta value is actually impacting your return. Okay, that's the interpretation we are giving in here. Okay, now let's move on. Okay, now so if beta equal to 0, then what happens? Okay, let's write it down here. Beta equal to 0. Okay. Now, if we go for if beta is equal to 1, then what happens? Okay. In that situation, if you take these things, okay, beta is equal to 1. Okay. And let's take it in here. That time, this one will be just 1, right? So it will have nothing like this. And we know our risk-free return is how much? Our risk-free return is 0.04, the RF risk-free return. You see? So this one will become our 0.04. Okay, I'll take it off. Okay, minus 0.04. Okay. So you can see this one and this one will be cancelled out by itself. If we cancel it out, and if we cancel this one out, okay, so we can get here that Rj is equal to Rn. Okay. You can see here that RJ will become RM. So now you can ask me, what is RM actually? What is this RM? RM is equal to your market return. What is your market return? Market return tells what the market is returning at that moment, at the specific industry, or at that time, the ASX, what is all ordinary. Okay, that's actually market return, you called it in here. Okay, and we should not have this one sign in here. Okay, so now let's talk a little bit about the other part now. So yes, so now we understand about the risk-free return. We understand about the beta. We'll talk a little bit more about beta soon. Now I want actually to show you guys what is these things coming up, RM minus RF. What are these two things? RM is your market return. What is market return? At the time, how much the stock market is returning. All ordinaries, all odd, we take these things. If we take the average of all odd, that's how we calculate about the average market return. And this RF is again your risk-free return. So market return minus the risk-free return, this one tells you about market premium. This is called market premium. Just going back in here. So if you take this one, this part is known as market premium. This is equal to okay, that's the market premium. So what is this? What is market premium is? Market premium is how much the market is paying extra on top of your risk premium, risk-free premium. Now the question is very simple. If the stock market is not paying more than the savings account, more than the bond, why should I invest in the stock market? Right? So yes, the market premium will be actually telling you this, that how much they're paying extra on top of this, on top of the risk-free return. Then if you talk about this whole part in here, this is the market is giving you this much, right? Fine. Now if you come up in here, beta into this, so these ones actually tells you that how much is the firm is giving you, the share you're investing, the premium for investing into that specific share. Which share is that? RJ. So this one tells you about premium or investing into RJ share, into share J. What does it mean? It means that premium for investing into share. So which means that since you are investing into this share J, you are asking for some extra benefit, then your risk-free return. How much extra you'll be getting? You'll be getting this much extra. That's your premium. Now, if your beta is minus, it will be reduced than your risk-free return. It depends on what type of share you're investing, what type of risk, I mean the beta value they have. Okay, if the beta value is negative, it will take it down. If beta value is positive, it means it's increasing too. So it depends on what type of business you're investing, Okay, like most of the people, like in one stage, I think here we mentioned in your assignment, in your lecture schedule here, we mentioned that a lot of people do not know how to process informations. Like on when you talk about criticize the CAPM method, you said it here. Okay, here some of the assumptions of the CAPM CAP model, capital asset pricing model includes what? They include existence of perfectly competitive capital market. This is not true. Capital market is not perfectly competitive capital market. Okay, this is not right at all. We call them normally actually efficient market, we call them, but there is a hypothesis. Normally, we take a semi-strong efficient market. The decision to buy or sell or any individual will not affect prices. The participants are the price takers. So market will decide the price and you will be taking the price. So no company actually deciding their price. The market will decide. No impediments to transactions, no transaction cost, no taxes. We also believe that, okay, I invest this much, I get this much in return. We do not consider that, well, we have to pay taxes on it. We have broker expenses too. We have transaction costs like brokerage fees or commissions, whatever you say. There are some costs involved in here too. So the income, the money you share is giving you, you have to take these things out. Some of the expenses that's related to it, your income. So that's a part of your return, okay? And you assume there is no taxes. There is taxes on your income. All investors have the same information. This is the one I'm referring to. All investors have the same information. Yes, they have the same annual report, that's for sure, because annual report is actually required by any corporation. Okay, they must have to disclose the annual report. I'm sorry, they must have to disclose the annual report. So they will have to give you the information about financial statement. What are those? Profit and loss account, balance sheet, cash flow statement, changes in equity. Like we talked these things on the first class. Okay, these are the 4 statements they must have to give you as a part of the annual report. So yes, but how many people, how many investors are smart enough to actually process those reports and come up with process those data and come up with some information about a specific company? They need financial analyst to come up with this conclusion, how risky the business is. Lot of people is there. Like if you talk about in Australia, there are a lot of mom and dad there, parents. They're investing their money for rainy days, for bad times. They do not have enough financial or accounting knowledge to actually process this information. There are a lot of them in there. So they actually go and ask for broker's advice. They go for financial analyst. It depends on who has what type of connection and where they want to go, how much they want to spend. It depends on so many things as well. Okay. And hold the same expectations about the probability of distributions of return for all assets. And they think all of the assets will be giving them the same return. It's not true. And this is very important, the last one, all investors are rational and risk averse. Rational, very important thing. The rational means they will not make investment where they do not find a valid reason. Because, like I said, humans are actually responsive to the incentives. Now, incentive not necessarily all the time will have to be financial incentive. There could be some other things. An older person, there could be some other things. Like, and for an older person, incentives could be spending time with children. A person who loves environmental activist, they might think, I'm going to invest in this company, even though my return is not very high, but this company is looking after the environment. That's the incentives you get. Okay, it depends what type of incentives you are looking for. What your incentives are actually influencing you. It depends on the situation. Okay, all right, let's move on. And okay, now going back to in here. So here, this is the whole point. You'll find the premium for investing into this company. So this is the expected return. You are expecting something more than the risk-free return, which is added up in here. Do you guys have any questions for me? Does it make sense to you guys what I'm talking about? And do you guys have any questions for me? Anyone? Any questions for me so far, guys?
No.
No, not yet. Okay.
Well, good. Thank you very much.
No worries. Let's move on. Are you guys understanding me clearly, or you want me to go slow?
It's okay. That's okay.
Now we understand it. Thank you.
Okay. All right. If I need to go slow, let me know. Don't hesitate to say that. Okay. Tell them that, okay, you're going too fast. We can't understand. So I'll slow. I'll speak slowly. All right. And okay, this is a line that you're talking in here. Okay. In this workshop papers, you will see at some stage that we discussed about error terms. Like here, they talk about what happens if the beta value is 0, and here is the beta value is 1. So we have discussed that as well. And security marker, I'm coming to that point very soon. Market risk premium, yep. Okay. All right, let me talk about this one now. This one. Okay. In this case, this is actually, I tried to show a relationship here about the market return and the return on security. This relationship that is established in here. Okay, this is the sample regression line. Okay, the data you have taken from some samples, and we draw a regression line in here. Okay, what is a regression line? Some of you might ask this question too. Yes. So regression line is your estimated line. Okay, estimated line. In this line, like I make an estimation. So we are making an estimation. Our estimation may not be all the time correct, 100% correct. It may not be precise. Okay, so our estimation line may not be precise all the time. So you can see we are assuming that it will follow this straight line. It is gonna follow this straight line. Okay. Okay, it's all right. Okay, we're gonna follow this straight line. So it means that every dot here has created this line. But in real life, do you see this one? This is observation for 1 year, observation for 1 year. So this is our actual, but we estimated it as in here, for example. We estimated it in here on this line, somewhere on this line, estimated in here. Let me see if I can take, if I can use something. Shape outline. I want to use a dot only, nothing else. Okay. The line. I don't know if I can use this line. Let me see. Okay, so it will be around like at this point, and let me take the color, change the color. Okay, I would rather go, this is fine. And I would like to say this point, okay? This point will be actually intersecting this line at this point. So let me take, okay, so format. Let me take the shapes in here. Okay, so this one could be actually have a line at this point. This point. Okay, this point. If you take it down more, this is the case, you can see. So this part, you can see this here to this here, this is your error term. So we thought at this point of market return, our estimated was actually in this one, estimated line at this point. Okay, but we have actually and I want to show you here. I'll take this one. Okay, and this part I will say is in here is your error term. This much is your error term, and this is your explained term. Okay, this is your error term. So you expected that this point, at this point, I will take, you expected that this is the point, this should be estimated figure, but you found that no, it's not. Actual was in here. So you made some mistake, the error term. Okay, these errors are coming up in here. So we say that these things will be coming up with some error terms. This has been explained in later. I'll show you. Yeah, you see this error term? This is the error term, random error terms. Okay. All right. Okay, now let's talk about this one, security market line in here. So what does it mean? The security market is a graphical representation of the CAPM model. It shows you the graphical representations, okay? It tells you about the, graphically they will show you the model. Expected return on a stock with beta 0 is equals to the risk-free return. So when the beta equal to 0, it means there is no risk. Beta will show you how much risk it is, okay? How much risk you are taking. Depending on that risk, how much extra return you should get. Okay. Yes. We said the SML, security market line, is a graphical representation of the CAPM model. Okay. The expected return on the stock with beta 0 is equals to risk-free return. I already showed you that if the beta equal to 0, then it becomes risk-free return. If beta becomes equal to 1, it will become actually rate of return for the specific asset or specific share will be equal to market share. All right, because market actually shows you a beta of 1. Okay. So they show that if, for example, expected return is greater than the required return for an asset, you're expecting more than the required. It means you are in positive, you are getting some, making an extra profit in here. Okay. As investors would invest more in that asset, pushing up its price. So when you actually stop, if everybody actually start investing into the same asset, same share, what's going to happen? The demand for the share will increase. The demand for the share increases, then what happens? Automatically price will increase. So when the demand has increased, the price also increases, and the price increases means the rate of return will be decreasing. Remember how it calculates these things? How much you invest and how much the share returns. So demand increases doesn't necessarily mean the share will be returning more. Actually, share will be returning less because of the price has involved into it because of the higher demand of that type of specific share. Okay. All right. So they gave you some of the examples in here. If the market return RM is 0.08, the risk-free return is this. Calculate the return on asset J for beta equal to this, beta equal to this, beta equal to this. So they gave you 3 options. Beta is less than 1, beta is 1, beta is more than 1. So here you can see market return RM 0.08. So using the formula that we had, remember the same formula they did, RJ equal to risk-free return is 0.5. You see that? Risk-free return 0.5. Then here is your beta value for question number A, 1.5. They put 1.5 as beta. And here is your market return, market premium. The market return is 0.08. Market return 0.08 minus 0.05. That's your market risk premium. 0.08 minus 0.05. If you have to multiply it with your risk. So you see, the market risk premium is same for both the situation. So what is the factor that is actually changing? Look at here. Look at all these three options. At RF 0.5, 0.5, 0.5, same. Market return, it also the same for all these three situations. So what is the factor that actually make the decisions in here? Your beta values. You see 1.5, 0.8, and 1. So beta values is actually here playing the whole game. Okay. So yeah, so this is they are trying to show you in here that here is 0. So required return, how much return is required? Definitely you need RF. You will definitely need RF, risk-free return. On top of it, you need something extra. How much it will be extra? It depends on how much risk you take. The systematic risk. So beta value is equal to 1, then you can see this, here it is. So this line, SML line, is actually showing you the slope. The slope is your actually the beta value here. Okay, the slope of SML line is actually your beta value. Okay, so here this is estimated line use. Okay, security market lines in here. So this much is your market premium, and this is RF in here. This is market premium, and it multiply this one with these figures in here, beta 1. Okay. All right. So now here, another one that says in here, sometimes it happens that because of some systematic risk, for example, in here, the example was given as inflation rate. Because the inflation increases, so that we have to change our risk-free return as well. So if the risk-free return is increasing, you see the whole line will be shifted parallelly and starting from RF, new RF, because this is your risk-free return. So your return, required return for any asset will go above your risk-free return, okay, at that specific time, okay. Risk-free return is not all the time the same. It changes. All right. I think so. Here is an example was provided. If you listen to the lecture, actually, that lecturer, Dr. Girija, has already mentioned these things. I will not go through these things now. I will take you guys to is that calculating beta stock price? Okay. Okay, I will take you guys to these questions now here. Okay. Actually, I would like to solve one problem so you guys can understand. Okay. It's actually solved in here. Okay, let's do this one. Okay. Okay, so we have a question solution in here where the beta value was mentioned as 1.5. And how do you calculate RJ? Okay, the solutions we had here, RJ was equal to the formula we had, return. I think should I take it from here? So they mentioned here that RJ, how much will be our RJ? We have to find out our RJ. Okay, return from, what is the required return from share J? Okay, so RF is provided. RF is provided as 5%, which is 0.05. Then your RM is provided is equal to 0.08. The market is providing, market is actually, the return from the market is actually 0.08, which is more than the risk-free return. Okay, and we have given beta value for 3 situations. For situation 1, this is the beta value. So now you can see here that this is your market risk premium. So you can say here market risk premium is equal to this, okay, which is equal to 0.03 market risk premium. And if you multiply it with the beta values, okay, if you multiply it, so this one, I think I should mention this too in here so that you guys don't get confused. Okay, this is the thing, market risk premium. And if you go for risk premium for share J risk premium, which is actually our, the whole thing, this will be equal to this one. Okay, so we added the beta value 1.5. Okay, so it will be equal to, let me calculate it. It should be 0.03. 0.045. Okay, so this is, let me make it a little bit smaller so you can see it in one line. So this is your risk premium. So you have to add up. So this is your risk premium for investing in share J. You will get extra of this much money. Now, if you add up this one, you will get this much extra on top of your risk-free return. Okay. So the market, so the share J risk premium is this. So you say here, share J required rate of return, which is your RJ. RJ, which will be equal to this whole thing actually. Yeah, will be this. Okay, when the beta value will be changing, beta value will be changing to 1, it will be different. Beta value changing to 0.8 in here, 1, and 0.0, here is 0.8, beta value will be different for different things. Okay. So this one, I should actually mention it here. Return RF. Okay, that's all we have for CAPM model in here. Yes. All right, now let's move on to our other problems to solve. Okay. Yes. Okay. So here the question we got in here. So under what condition will the population standard deviation, remember that we say population standard deviation will be your sigma, okay? And if it is sample, it will be as this. So they said, under what condition will the population standard deviation of return to a 2-asset portfolio be the weighted average of the 2 assets standard deviation of return? What did they say? They said, under what condition will the population standard deviation of the return of 2 assets, population standard deviation of 2 assets portfolio, be the weighted average of the 2 assets standard deviation of return? So they said, hint is consider the formula for standard deviation for a return of 2 asset portfolio given in lectures and recall from the high school that this, okay. So these things we have done in last class as well. If I go back to last class, I'll show you where it's coming from. Okay. Here it is. Okay, for examples of two asset portfolio of assets 1 and 2, the population standard deviation of the probability distribution of portfolio return is given by this. So this is our equation. Notice very interesting here that you see here sigma square. Sigma square is your variance. Variance of return 1 is weights. And you can see here, very interesting term, very interesting one is this one. I'll show you this one. This is called rho. This is called rho. Look, this is our square. We understand W1 sigma 1 R1 whole square. W2 sigma 2. W sigma 2 R2 whole square. But this one we could have called the whole thing that this as we could treat this as A. This would be treated as B. So A square plus B square plus 2AB. But the problem comes up in here. This one rho is equal to rho 1 2 rho. What is this rho? Rho is actually your correlation coefficient of returns on asset 1 and 2. So this means that how strongly they are related to each other. How, who they are? Two assets, return of these two assets. How these two assets are actually related to each other. That's what your rho is gonna tell. Now, in this question in here, if I go back now to our problem set, if I go back to our problem set in here, so they say that what situation it will be this. So this says here is very simple one. We note when the two assets return are perfectly positively correlated, so rho 1 2 will become equal to 1. When rho 1 2 becomes equal to 1, now you can see here. Now rho 1 2 becomes equal to 1. Okay. Okay, I think this is an image. Yes, it's not getting converted. Okay, so you can see here this row part. You can see here this row. These will become 1. When it becomes 1, then whole thing will become. You can see sigma equal to weighted average only. Okay, so when the correlation coefficient or rho of these two assets will be 1. Okay, the correlation is 1 there. It means they're perfectly positively correlated. At that situation, what happens? Your population standard deviation will be equal to your weighted average of the two assets. That's what I'm talking about. Okay. Weighted about two assets standard deviation. Okay. Let's move on. Okay. So weighted average of, you see that? Standard deviation, sigma. Okay. Standard deviation. When the sigma is square, that becomes variance. Don't get confused with that. Okay, sigma square is your variance, sigma is equal to standard deviations. All right, next let's move on to our second questions. Okay, our second question is talking about possible rate of return you might expect by investing in shares C and D are as follows. Okay, so this says calculate the expected return and standard deviation for both shares C and D. Express your answers as percentage rounded to 2 decimal if required. So yeah, so this is about rounding questions. Okay, tell the expected return and standard deviation for both C and D. So we have to calculate our expected return. Okay, yeah, and the standard deviation of that one or two. Okay, so how do we actually do that? Let's solve this problem. Let's take this one and So this is our question in here. Okay. How do we do that? First one is calculate the expected return. How do you calculate expected return? Okay, let's go in here. Let's calculate expected return. Okay. Expected return of share C. Right, that's what they're looking for. Expected return of, I think I have already. Okay. Expected return on share C. How are we going to calculate that? We say E C will be equal to, remember our probability things? Okay. Yes. So we are actually going to calculate our expected return. How do we do that? We have to multiply, you see, the probability with our return on C. Okay. Then plus multiply, plus add it up with these two, product of these two and the product of these two. Okay, difference of these things. Okay, let's do this one. Okay, so this is -5, 8, and 14, 2, 5, 3. Okay, so it will be equal to 0.2. Okay, yeah, multiplied by -5%. Okay, multiplied by minus 0.0. It's easier when you actually use them in decimal rather than percentage. Okay, it's easier to calculate. Okay, this one. So I know now I have actually multiplied these two items, like these two, 0.2 and 0.5, which is for economic condition as poor. They have given you three economic conditions. One is poor, average, and good. The economic condition to be poor is 20% possibility, and average is 50% possibility, and good is 30% possibility. Okay, so we are actually trying to multiply these two and get the product like WR, remember? That's what you're trying to do. So here in this case, you're doing actually probability P into return on C. This plus, with these things, we have to add a plus. We have to do now 0.5 and 8%. So it will be 0.5. It will be multiplied by 0.088% plus. We have to add up here now 0.314%. So it will be 0.3, okay, multiplied by 14%. So it means 0.14, 14%. Okay, that will give us how much? Let me calculate it using my calculator here. Mm, 0.2 multiplied by 0.05. So this one give me 0.01, 0.01 plus next one will be coming as 0.04, 0.04, then plus it will be coming 0.42, 0.42. Okay, I think it is 0.042 because you have 0 in there. So altogether, the answer should be coming up as 0.042 plus 0.04 plus 0.01. So altogether it will be 0.0. So it should be 0.092, which is equivalent to 9.2%. I think I reduce this thing so you guys can see the whole thing in one line. This is the one. Is it big enough for you guys to understand?
Yep, it is.
Okay, good then. Okay. So you guys can see what's happening in here. Yeah, all should be fine now. Yes, so this expected return on share C, and now we're going to do the same thing for expected return on share D. Okay. On share D. This is on share C. Okay, so let's move on. B on share D. And this is remain the same. Our economic probability remains the same. The changes are -3, 5, and 10. I think I made one mistake on previous one. Sorry. So this one should be actually minus sign, right? That's the mistake I have made. So this should be actually minus, not plus. It will not be 0.092. It should be actually that time you get on 7.2. It should be actually 0.72. 7.2 is actually minus sign. It should be at the beginning. It should be minus in here. Okay, this one you see, you might, yeah, this one minus. In this case here, it should be the same. It should be -3, 5, and 10. So it should be -3, and this is 5, and this is 10%. 10%. So it will become here 0.015, I believe. 0.036, 0.02, 0.006, 0.006. Okay. All right. And here 0.05, 0.5, 0.05, 0.025, and here 0.30. So this one is gonna give me, this is actually minus. So this one should be here. 0.025 plus 3 equal to this minus 0.006, 0.049, 0.049. So it should be 4.9%. Should be 4.9%. Okay, so yes. Okay, that's how you calculate expected return on share. Okay, that's your average expected return, average one that you say. Now we can actually calculate standard deviation. You're gonna calculate now. Okay, how do you calculate standard deviation? Okay, now we have to actually. Okay, now let's go for standard deviation. Okay, let me actually do this. Equation. Okay, let's say it's where you have to go for sigma. Okay, here is our sigma. Sigma should be actually sigma for C. Okay, should be equal to, we have to use a root, right? We're gonna use this one, a root. Okay, sigma equal to root of averages, right? So it will come up as your first one, like here you can see, that you return 0.05, okay, minus will be your the average. You see that, this one, 7 point, this one I'm gonna use now, okay. And how are we gonna do these things? So we are actually going to make some brackets in here, okay. So we are actually calculating, -5, okay, minus our, the first one you can see that are 5%, like 7.2%, okay. So you can go it like 0.05, you can go that way. You can go for this way as well, like 0.05, okay, minus 0.072, 72%, okay. And this one needs to be actually, and this one is needed to be actually square. Okay, so I'm gonna do it again. This to be square, okay, and this has to be multiplied with your probabilities. Okay, how much is that? That is 0.220% probability. Okay, this is one. So like this, we have to do the others as well. Plus, we have to do the other one. Okay, so let's copy this one. And you're gonna add it up for other situation. Okay, and it should be plus other situation. So it is not 0.05 anymore. This is now actually 0.08. Okay, so if you go for this one, 0.08 into 7.2, and the second probability was actually 0.5. 0.5. Okay, and this, in this case, this was not 0, this is 0.14, which is 14%. Okay, into this whole square, and here is 0.3, I believe, 0.3. So this is the way you calculate your sigma square. Okay. That's the sigma square calculation. Okay, so how much it will be? Okay, so this one I will say, let's go in here, should be equal to, let me do the calculation here. Actually, I'll look at the solution, and this one will actually will be equation equal to 0. Let me do the calculation. So 0.4396. I'll do it. So it's actually.
Excuse me, sir.
Yes.
They don't have minus in the 0.08, I think.
Minus the second one.
Yeah, and the third one.
Yeah. So this one I want to take straight. copy this part, and if I put it straight here on Google, how much? 0.004396. 0.00, oh, no. So it is 0.004396. That's it. So this is the answer you have. So this one is, you can say, this is equal to your root of this. You can check it out from Google as well, copy. And root of this one should be 0.663. Okay, which is 6.63. No, or 0.0663. So there is 1 0 in here. 10663, which is equal to your 6.63%. Exactly the same thing we have to do for sigma D. Okay, so this is our standard deviation for share C. Okay, so we do exactly the same thing in here. Share D. So probability remains the same. The market will be changing at 4.9. This is not 0.72 anymore. It will be actually 0.049. Okay, so you change these things. Zero point 0.9. Probability remains the same, and the percentage minus 3, 5, and 10. So it is minus 3. So this one goes 3. This one is 5. Okay, 0, 5. Okay, 0, 5, and 10. This is 10. Okay, so the figure will be changing as well. 0.002029. Okay, so this is my answer. Okay, so this is, okay, so this is the answer I have. So which will be equal to, so root of this should be equal to your root this equal to 0.0450. It is 4.5%. Okay, so we got now standard deviation for share C and share D, both of them. Okay, that's the question for your first one. Percent rounded to 2 decimal points, so don't go for more than 2. That's what they mean, the 2 decimal points. Don't go more than 2%. Okay, and what else we have? Here, look at here. I have gone through more than 2. See, 0, 0. Oh my God, it's a, it's a lot, yeah. Okay, second question, calculate the standard deviation of returns on portfolio with asset weights of 70 and 30% for assets C and D, respectively. Okay. So this is calculate the standard deviation. Calculate the standard deviation of returns. Okay, for a portfolio with assets weight of 70 to 30% for assets C and D. Again, express your answers in percent. Okay, rounded to decimal. Okay, that's what they're looking for. Okay, fine. So we have to calculate these things now. Okay, first you have to calculate the portfolio return. You have to calculate first. Okay, first you need to calculate portfolio return. All right. So it said 70% and 30%. You see that this says calculate the standard deviation of return on portfolio with an asset of standard deviation portfolio with asset of 70% and 30% for assets C and D. Okay, the 70% and 30%. Okay, the 70% assets you're investing in share C and 30% you're investing in share D. Okay, so the poor situation, what will be your answer? For the poor situation, this time you do not go with the probability, you go with weights. Okay, this time you're going with weights. First you have to calculate the portfolio return. Okay, after you calculating the return, then what you do? Then you will be calculating like here we did the same thing in here. First you calculate your expected return. Okay, expected return at C, expected return at D. After you getting the expected return, then you have to do exactly the same thing that we have done here right now. Okay, with the new things. I'll do it and I'll show you guys how it works. Okay, I'll show you right now. Have a look. So this is question number B. Okay, so let's calculate about poor situation. Okay, and the poor economic condition. Okay, what happens in poor economic conditions? That time is 70%, and how much was our return in here? -5 and -3. So we'll go for C 70%, and this one is 30%. So we will multiply -5 into 70% plus -3 into 30%. That's what you're gonna calculate. So let's do it in here. Poor economic expected return of poor economic. You should write down here. Expected portfolio return. Expected portfolio return on in poor economic conditions. Okay. So how much it will be? It will be 0.7. Okay, multiplied by minus 5%. So it should be 0.05. Okay, plus you have to go for 0.3%, 70 and 30%, and multiplied by minus 0.03%, they said, right? Okay, that will be equal to how much it will be? I believe. So copy this and take it straight to Google. It will be minus 0.044. So this is equal to minus 0.044. Okay, 4.4%. So now you do the same thing, expected portfolio. Look, we said the portfolio, that's why you're taking C and D both, but you're multiplying them with their weights. You see the weights here? Multiplying them with the weights and return. That's why you call it portfolio return, okay? This is not individual share return. Individual share, we have done it for individuals. You see that here, look at here. All these things are for the same share and their probabilities. But in this case, we are working only The portfolio means you have to bring both share A and share C and D with their weighted average. Okay, so that's how we're getting in here. And expected return on, let's come up with the same thing, expected return on portfolio for average economic condition. Average economic condition, again 70% will remain the same, 30% remain the same. What will change? The return is about how much? 8% and 5%, C and D. So it should be 8%, no minus this time. This should be 8% and 5%, 5% and nothing. And the answer should be here, this 0.071. Okay, the answer should be actually not minus, it should be 0.071. Okay, let's do exactly the same thing for our expected return on poor average, and let's do it for a good condition, good economic situation. Okay. Yeah. In this case, 70-30 will remain the same, nothing wrong in there, but we'll go here. I remember the first one is 14 and 10. 14. 14% in here. 10%. Okay, and let's do the answers in there. It's 12.8%. Okay. Yeah. So now we know our expected portfolio return, right? Okay. Now what we need to do, after we calculate the portfolio return, now we are going to do the expected portfolio return, is how much is in our, for the whole economy. We're gonna do, now we're gonna add up all of the three situations, right? Like this one, okay? Like this one with the probability, this one with, now we know the average portfolio will be this, and now we're gonna actually integrate it with our probability situation. Okay, 0.25 and 3. So we are going to actually calculate our expected return for the portfolio. Return for the portfolio, how are you going to calculate it? We are going to calculate it like we said here, 253. Okay, we're going to calculate it like 0.2. Okay, I think these things can be actually used. You can convert them. You can take them into equation like this, and also these things can go straight to the equation. If you click like this, select them and just click on equation, the number will automatically convert into the new equation. You see that, so it's now in equation format. Yes. Now, actual return of the portfolio. How are you going to do these things? Control B. 0.1, 0.2, 253, 0.2 into multiplied by minus 0.044. Okay, bracket close. Then we'll have to go for plus 0.5 multiplied by 0.044. 0.071, okay, bracket close, plus you have to go for 253, so it will be 0.3, it will be multiplied by 0.1280. Okay, should be equal to what? You're gonna find it out now. Sorry, is equal to 0.651 is equal to 0.651. Okay, which you can say straight 6.51%. Okay, and you select this all and make it as an equation. Done. Okay, that's it. That is your, now we know our expected return, which is 0.0651. Now, calculating standard deviation, oh, easy, like the previous one, remember? We'll bring up this one. Okay, now we are doing for the portfolio. We are just copying the formula from same format, but actually we're gonna do, actually I should take it like this. Copy it, so I don't have to type it again. Standard deviation, I will say that standard deviation for not share anymore, it should be portfolio. Okay. It's not one share anymore, it's now the whole portfolio. So here the sigma is not D anymore, it should be P. Okay, and you can see here our, for the situation, we have three situations in here. For the first situation, we actually have to look at here, what is our first situation? Our expected return for this, look at here, is 0.044. You see that, 4.4%. From here, this is individual, okay? Expected return portfolio, expected poor economic situation, individual one. So if you go in here, for the individual one, poor, average, and good, we have some return, expected return with portfolio, 70-30% portfolio, okay? So now you go in here, or you can actually, I think I can do that here. Let me see if I can do that in here. Insert column to the right. Let's see if I can fit it in. How to fit to the window. Okay, so you can see here, return of portfolio. Okay, so three situations we have. Minus 0.044. You can see here for poor, it will be minus 0.044. The second one, you can say 7.1%. Okay, so it should be 0.071. And here, if you go by percentage, we have to do 4. I think I'll do it percentage because everything is in percentage on the table. I'll do it in percentage too. 4.4%. This one is 7.1%, 7.1%. And this one is actually our 12.8%. So this is our portfolio return in this situation. Portfolio of what the portfolio is, C. Okay, share, I'll say share C is equal to 70%, so I'll say 0.7, and share D, that's my portfolio, okay? Share D is equal to my 0.3. So this is my portfolio, okay? So this one goes down, share C, this is share D, okay? That's my portfolio, okay? C and D 70-30, this is the outcome I'm expecting, okay? Portfolio of, return of portfolio for Share C 70%, share D 30%. In that situation, this is our return we get. So, and we got actually our average, weighted average as well from there, and which is here came as 6.51. Okay, so this is our average. Okay, actually average, actually return average one. So we are going to do the average in here, 6.51. Okay, 0.0651, 0.0651, 0.0651. Okay, and I have to put here our average one, which is minus 4.4, 7.1, and 12.8, which you can see from here as well, 0.044. So 0.044, and here 0.071, and here 0.1280. Okay, so now you can see our, at poor situation, our portfolio return minus the average of the portfolio return of that period, multiplied with the probability of 0.2, 0.5, and 0.3. That's our probability in. Okay, now let's calculate this figure, how much we get from here. I want to take within the root. And here you go. So we got here like 0.00358489. So this is actually our variance. Okay, we have to root it, then we get the, so yeah, it is in here. Okay. And if you root it up, if you take the root of this figure, it will be your 0.0598. Which is equal to 5.98. Two decimal. That's it. There's a division for the whole portfolio now. Okay. Yes. Yeah. All right. So what else we have here now? We have done question number 2. Let's have a look on what we got on question number 3 in here. I think I'll show one more question. Here. Okay, this is another question we got in number 3 in here. Let me see what else we got. Number 4 is very, okay. Mean and standard deviation. You can do this one. This is very easy one. We just done this one. If the mean return on asset is the for in, and this one, calculate the mean and standard deviation. You can do this one. We have just done these things right now. For 2 of them, you can do that. And I'm not sure which one should I go for, number 3 or 5. Calculate the portfolio standard deviation using the above data. Okay. I think I'll do it the number 3 and finish it off quickly. Okay. All right, this said, it's almost the same thing. The following table shows the returns on ordinary shares A and B in their possible state of nature recession, normal, and boom. So we got that average, normal, and like we got that one like bad, poor, average, and good. But here you have recession, normal, and boom, these things. Okay. So first one, I think you guys can do the first one. Second one is that if a risk-averse investor had to choose between holding a share and holding share A and holding share B, which would he or she choose? Give a reason for the answer. So now have a look on their standard deviation. Okay. Let's have a look. We have the solution in here. Let's have a look. Looking at these things, look at the standard deviation in here. For share A, standard deviation is 1.5. For share B, standard deviation is 3.66, which is higher. So the higher the standard deviation is, higher there is uncertainty, higher uncertainty in there, higher volatility is involved in there. So we will not choose share B, we will choose share A because it has less risk. And risk-averse people will always want to avoid the risk. Okay? Yes. All right, what the next question is, if an investor were to form a portfolio consisting of A and B shares, would it be possible for the portfolio to offer a lower standard deviation for return than both A and B? So if we combine these two, we make a portfolio, share A and B, not separately, but we combine them, some percentage in A, some percentage in B like this. Would it be possible to actually lower the standard deviation, which means lower the uncertainty? Okay. The answer is no, it will not. Okay. You can look at here. You can look at here one interesting thing. Share A return is increasing. Recession, normal, and boom, you see, it's increasing 4, 6, and 8. But return on share B is decreasing. See, 12, 5, and 2. And you see the interest, they are negatively correlated. One is increasing, another is decreasing. It means they have a negative relationship. Remember I told you on the other day in the class, I draw the graph and showed you that if they are positively related, it will be upward sloping. If they're negatively related, it will be downward sloping. In this case, you see that one is increasing, one is decreasing. It means they do not have a positive relation. They have a negative relationship in here. Okay. So what does it mean? Okay. So it means that they may be combined. You can combine them. You combine them with the lower standard deviation of return, okay, with the lower standard deviation of, okay. So what you can do is you can actually combine them, like probability of recession is 0.2, but you see the rate is 4, but here rate is 12. So it depends. For a risk averser, they will not. It will not actually give any much benefit in there, okay. Yes, I think I will stop it here and let's do our attendance. And next week, maybe we'll cover a little bit more. Okay, of these examples. Okay, now let's do our attendance and we will stop it there then. Okay, let me get into our attendance sheet, which is in Dropbox.
Excuse me, sir. Can you share this solution with us? The one
already there. I will.
I know there's a solution, but
Yeah,
the
I will
one
make it available to you guys. Right now, I'm gonna do these things.
Okay, thank you, sir.
Which is solution 3.
No, because the one you just did, I think it's a better version. So
yeah.
Thank you, sir.
So workshop 3 in here. Sorry, 4. And we have to. I'll call you names soon, okay? Then you guys can actually see. Okay, that time. I'm just trying to make it available to you guys now. Workshop answers. Is it available to students? Let me check. Make it available. I make it available to you guys. Okay. Okay, answers to the workshop should be available now. Okay. Let me get into Dropbox. It's taking a little bit time. I didn't need that. Why it says sign up? I already signed up. I need to go for sign in. Okay, so it came now. So it should be on Wednesday's class. Today's class started on 30th. All right, let me check here with my participants number. And, oh gosh, okay. Let's see if I can freeze it. And let's freeze it in here. Can I go to view, freeze pen, freeze the pen? Yeah, good. Now I can do it better. Okay, now let's go in here. All right, let participants in here. All right, is Muhammad Ali here?
Yes, sir.
Yes, thank you very much, Ali. Oh, why, yes. Then Sarah Jabinalam.
Yes, sir.
Thank you very much, Sarah. Is Jantin here? No. Then Anusun.
Yes.
Thank you very much, Anusun. Michael, you there? Michael, no. No, Michael is not there. Let me put my video too. Michael is not there. Faris Hassan, is Faris here?
Yep, I'm here.
Okay, Faris, thank you. I know it's a little bit time conscious. Justin Hai, I think I see his name already.
Yeah.
Yeah. And Zheng Yang Huang, you there, Zheng? No? All right. If I miss any of you, let me know. Somebody actually texted me.
Yes.
But Anmol Kaur, I think I saw Anmol's message.
Yeah, I'm present.
Yeah. Yasmin Lopez, you there? Yasmin Lopez? No? Okay. Then Tarek Obaid, I think I saw Tarek. Yeah, Tarek, I can see here. Then Anmol, I think Anmol already texted. Okay, Anmol Kaur and Anmol did. Two of Anmol Pradhan did not send me. Anmol Pradhan, you here? Anmol
Yes.
Pradhan?
Yes.
Yes, okay, yes, thank you.
No. I'm Anmoldeep Kaur.
Okay, I have already done your one. So this is another person. Anamol Pradhan. No, it's not there. Gianna Chin.
Yes.
Good. Thank you very much, Gianna. And Sullivan. Sullivan, you there?
Yep.
Thank you very much, Sullivan, for responding. Carla. Is Carla there? No. Okay. Wifey, I can see Wifey.
Yeah.
Baihul Jang. Is Baihul Jang here? No. Okay. Anyone else? Maha? Maha here? No. Kutik already sent me a message. I saw that. Yeah, that's it. So thank you very much, guys, for coming in today. Okay. I appreciate your support. I appreciate your cooperation as well in this difficult time. I appreciate that very much. Also, if you have any questions, any problem, please don't forget or don't hesitate to send me an email. Okay. Or also, if you have some queries, please don't hesitate to send me email. I'll try my level best to respond as quick as I can. Okay. Yes.
I want to ask about the quiz that we have to do this week.
Quiz. Yes. Thank you very much, Janko. Yes. Quiz is actually it. I did not see it uploaded yet, but let me see. Let me close this and let me see about the quiz. So
Sorry, can you hear me?
So our quiz should be assessment 1 30%. So here you can see practice question for quiz 1. I can see that one. Yeah. Online homework 1. So I think this is the one. I don't know if it's available right now, Monday for 30th of March. Okay, I think it should be available now. So if you click on that, yeah. So you can actually go and check it. I did not check it. I don't know about it, to be honest. I didn't set it up either. So yes, I can't talk much about it. Okay, Tarek. Yeah, Tarek. I actually marked you attended because I saw your name and everything. Yeah, I saw your name on it. Thank you. Yes. So if you then you have 2 hours time. It's test time 2 hours time. Test will save submit automatically when time expires. This test can be saved and resumed at any point until the time expired. The timer will continue to run if you leave the test. Okay, so if you want to do something else during the time will be keep counting. So don't do that, please. Anything else, guys, you want to ask me?
No, all good, thank you.
All good. Thank you very much for coming in today then. Okay,
Sir.
yes.
Thank you, sir.
Thank you very much. Thank you too, man. Okay. Thank you very much. Thank you all. Okay. I'll see you guys next week.
All right, see you next week, sir. Bye-bye.
Thank you. Bye-bye.